All right, welcome everyone to the first SAM social matching in macro and finance seminar of the autumn term. We're very happy today to have Guillermo Ordoñez presenting business liquidity and information cycles. As usual, we'll have 1 hour of presentation with our panelists, and then after 1 hour, we have 15 minutes of Q&A where the panelists, but also the regular attendees can ask questions. The regular attendees via Q&A, and the panelists just by asking directly. Yeah, so let's begin. Guillermo, the floor is yours. Please go ahead.
Well, first, thanks a lot for the invitation. It's great to be here. I participated several times as an attendee, so it's great to present today. So in this is a joint work with Gorka and Bostansi. We're trying to understand pretty much how business cycles, liquidity cycles, and information cycles interact with each other. And the common theme of their interaction, or the common actor in their interaction, is going to be stock markets. So let me just start saying that we all know and is well recognized that stock markets play two critical roles in the economy. One is an information role. They tend to aggregate dispersed information and reveal it publicly through prices. And this is important usually for allocation purposes, allocation resources. But also they play a liquidity role because they can be quickly turned into cash. Now, this liquidity role usually is called market liquidity, is obtaining cash by selling your assets, and usually compete with what is known as funding liquidity, which is obtaining cash by obtaining a credit, usually given by the banking sector. So the questions that we want to entertain in this paper are, first, whether the liquidity role of stocks enhance or weaken their information role. So how these two roles of stock markets affect the information role and the importance for allocation in the economy. The second question is, how do business cycles, in particular recessions, and liquidity cycles, in particular banking crisis, affect credit informativeness and the role of information stock markets? And the third is, okay, we're not only interested in the role for information per se, but what is the effect for real outcomes? The main insight, if you want one, on this paper, that's the main one that I want you to carry home, is that not all recessions are the same through the link of banking crisis to real outcomes given by the stock markets. In particular, if you have a recession with banking crisis, prices become less informative and allocation get worse. But if you have a recession without a banking crisis, then prices are more informative and allocations get better. So banking, effectively what we're trying to put here is what is the effect of banking problems into the real economy. But the mechanism, we think, we haven't seen it so far, is through the way the stock markets convey information in the economy. There are other stories of banking crisis making things worse, like credit allocation, but this is going to be pretty much by information revelation, okay? It's going to be a different mechanism. So the way we want to proceed is in three parts. One is theoretical, the other is empirical, and the last is quantitative. So those are going to be the three fronts through which we want to make this point. On the theoretical part, we want to build an RBC model with heterogeneous firms to allow for allocation and stock trading to allow for this informativeness of stocks. Now, in this stock trading and stock markets, there's going to be endogenous information acquisition that's going to give rise to the informativeness of stock prices. But we're going to depart from the standard one. So far, it sounds like Grossman-Stiglitz. We want to depart in which we want to have, instead of having noise traders as usual to allow for information acquisition, we want to have rational traders that are heterogeneous on what they care about stocks. In particular, you're going to see it more clearly, we're going to have two types of traders. Some traders care more about the fundamentals of the firm because they pretend to maintain the stock. The other traders are going to care more about the liquidity characteristics of the stock. And both of them are going to acquire information, but one type of trader is going to become a noise for the other type of trader. So in that sense, noise is going to be endogenous in our setting, but without resorting to standard exogenous noise traders. And in this sense, the price informativeness is going to be endogenous to changes in the importance of these roles that I was mentioning of stock markets. Now, why this informativeness going to be important? Informativeness about the fundamentals of the firms, how much stocks convey about the fundamentals, because the real sector going to use information conveyed by stocks to make real decisions like investment. And in that sense, what I want to highlight here is that we want to focus on what we call revelatory price informativeness, which is sort of different on the type of price informativeness that the literature has been recently trying to understand or measure, which is forecasting price informativeness. So a lot of the literature asks the following question: how much prices today tell me about the earnings of the firm in the future? Okay, we call that forecasting price informativeness. What we're after is different, is how much prices today tell you about all information that exists today in order to make investment decisions today. Okay, so there is some little differences there that I'm gonna highlight on why these two concepts may be different and their measure may tell you different stuff. Now, on the empirical side, we're gonna, given this module of the stock markets, going to be able to have a structural object to measure price informativeness in stock markets. So we're going to do that and measure the extent of price informativeness, this revelatory price informativeness, for many countries in many years. And that's going to allow us to do a couple of things. First, we're going to see how information cycles relate to business cycles and liquidity cycles in the data, because again, we're going to have multiple countries with crisis and multiple recessions. And the second, because this is a structural estimation, not a reduced form estimation, we want to be able to decompose the contributing factors that underlie changes in the informativeness of stock markets. Okay, and I'm going to show you that. And then on the third part, the quantitative one, is where we're going to make this module, we're going to put it into the RBC model with heterogeneous firms, and we're going to ask how important this is for the allocation of resources in the economy. This is the point in which I'm going to show you that quantitatively, recessions are cleansing or saling, depending on banking performance. And again, when stock prices, just the operation of stock prices with endogenous information acquisition, allow you to reduce the losses that comes from negative productivity shocks to have according to our calibration. But when those recessions or those negative productivity shocks come with negative banking shocks or come with banking crisis, stock markets tend to magnify the effect of productivity shocks. In fact, duplicate them. And the last thing that I'm going to show you is that an economy is more resilient when information about fundamentals is cheaper or easier to acquire. Think on regulations that, like SEC regulations that improve earning reports or things like that, that allows better information about the fundamentals of the firms. But the economy is less resilient when regulations make information about the liquidity of stock markets easier. Okay, so it depends on what type of information you're thinking, is whether you want transparency or opacity in the system. Okay,
Yeah,
so
yes, you didn't talk about, but like, did you look at what would happen if you have a pure banking crisis, like creating a allocation where the economy would be doing fine?
Yeah, we're going to be able to do that. That's not what I'm going to show you. I don't know if we did this particular exercise, but you're going to see that it's very easy to do that exercise in our setting. I can conjecture. I will not be able to show you, but let's maybe talk after the talk about that, because I will not show you that, but it's straightforward, and we can conjecture how it's going to look like. My conjecture is that it's going to make things much worse. But let's talk about that later, Bruno. Thanks. But I will not show you that. I'm going to just compare recessions with and without banking crisis. All right. So just for us to focus on how we're thinking about this. This is a standard classical RBC model with heterogeneous firms. How that would look like usually? Well, you're going to have the problem of a representative agent who decides intertemporal consumption, and a problem of a firm that maximizes profits, given that the firm has some idiosyncratic productivity shock, right? This small ZI. So the equilibrium conditions are usually given in this standard RBC model by the standard Euler equation that equalizes marginal utilities of consuming today and tomorrow. And basically, the firm going to decide to equalize the individual marginal product of capital with the interest rate in the economy, okay? And then markets clear. So this is a standard one. What we're going to change here is that instead of everybody observing ZI, what happens is that there's going to be expectations of CI given the observation of prices. And that's the module of stock markets that we're going to focus on. So how stock markets tell you about the ZI, the expectation of the idiosyncratic productivity. And then, as you can see just from this first order equation, that's going to affect the allocation of resources in the economy. When prices are completely uninformative, all firms are going to have the same expected ZI. We're going to allocate the same stuff to all the firms. When we have better information from prices, there's going to be a better allocation in the economy. So that's going to affect the static inefficiency. And on top of that, given the allocation is going to end up affecting the interest rate in the economy, there's going to be also dynamic misallocation because that's going to affect investment down the road. Okay, so that's going to be the RBC module, but this is the part that I'm going to be focusing on a lot. Okay, so for the sake of time, let me skip the literature, but I'm going to be talking about some of these. A lot of you are listed here, but basically this is connected to the literature and the real effects of stock prices. Like Joel has been working a lot on that. The cyclicality of misallocation as well, but we're going to focus on the two roles of stock markets. And then we're going to touch into this discussion of how to measure price informativeness and what type of price informativeness you want to measure. Okay. So unless there is any other question, let me just go straight to the model. The model is going to have agents, two types of agents, traders who live for one period and infinitely live consumers. And there's going to be also a mutual fund I'm going to tell you in a second, but that's more like an aggregator. So traders have a cara utility function given by that, and consumers have a CRRA utility function. What is important here is that traders come in two types. Gamma of them are day traders. These are the traders who care about the possibility of selling their stocks early on. So they care about the liquidity properties of the stocks, how easy there's going to be to sell them. And the rest are night traders. These are the guys who expect not to have liquidity shocks and really care more about the fundamentals values of the stocks. Now, this gamma is going to be an exogenous process that follows a Markov process. But I want you to have in the back of your mind the following story, okay? Because there's going to be a lot of loading into this gamma. The way we're thinking about this gamma is banking or the operation of banks. We will not model banks explicitly, but the way we're thinking about that is imagine that banks function very well in providing credit to face liquidity shocks. And now imagine that banks stop working well and there is no credit. Now more traders or more agents are going to rely on stock markets to obtain cash. And that's going to be an increasing gamma. So if you think of banking problems or banking crisis, that would be in the model similar to a big increase in gamma. Okay, I just want to make that clear because that's going to be a clear linkage in the model of how I think about gamma. High gamma is banking problems because that's put pressure into the liquidity role of stock markets. That's the other way in which agents can get cash.
Just a quick question.
Yes.
Sorry, on this. So you're not assuming there's any fluctuation in the total share or measure of traders. So these, when day traders come in, night traders go out, which is a little different.
Right. So no, exactly. So the way we're thinking is that there are 100 traders, but now 20 of them just rely on stocks and 30 used to rely on banks. So they really care more about the fundamentals of the stocks, but now they start worrying more about the liquidity properties of stocks. That's how we think, but we're not moving the total mass. Yeah, that's a good point. Thanks, Ray. So how about technology or firms? So the profits of firms, so this is the production function. Notice here it's going to be linear. There's going to depend on the idiosyncratic productivity shock, ZIN. But notice that here we split capital in two types. One is legacy capital, so capital that is installed in the firm, and the other is capital that can be adjusted. Okay, so this capital KI that can be adjusted at a cost, RI, so that's renting the capital and some adjustment costs. Why we're making this distinction? Because this capital is the one that traders are gonna buy and sell, okay? So they're gonna trade shares on the stock, effectively, stock market, on the stock of capital in the economy. Investors or the households, when deciding investment, the consumers, when deciding investment in their intertemporal problems, going to decide how much to invest. That's going to end up affecting the capital that get adjusted. And this way, we are allowed to separate we have these two modules of investment on one side and trading on the other side. Okay, I just want to make that clear because there's going to be three assets in the economy: the shares of the firms, as I mentioned. There's going to be shares on this part, the legacy, the stock of capital. The trader is going to own the shares. And again, as I mentioned, night trader is going to care about the fundamental value of the firm or per unit of capital, the fundamental productivity, plus the price at which he's going to be willing to sell the stock in the future. The day trader is going to care about the same thing, the fundamental value and the future price, but also is going to care about the liquidity properties. And we're going to capture that by a discount that they're going to have to pay for selling their stocks early on. So whenever I say the liquidity properties of the firm, we're going to capture it by this discount on selling stocks. I'm going to tell you later how we're thinking about that. We're right now working on having a broker, and that's why presenting in this group is great. A broker story in which they have to sell the stock to a broker, so we're gonna pay a fee for that. That's what is gonna capture that part, okay? That's the difference between night traders and day traders. Now, on the non-fixed capital, this part, basically what happens is that consumers gonna decide to investment, depending on that interest rate, they're gonna give the capital to mutual funds who are gonna decide to allocate it across firms. And the way we think about it is mutual funds give capital to firms at a condition and interest rate that depends on the realized productivity later on. So the mutual fund gonna extract all surplus exposed from firms, okay? So again, the mutual fund gonna extract all surplus exposed from firms. I'm gonna give a take it or leave it offer, a menu contract that specifies that, and then it's gonna rebate all that to consumers, okay? With a given interest rate, aggregate interest rate.
Guillermo, can I ask you a question?
Yes. Hey, Ben. How are you? Sorry.
What's up, man?
Many of you I haven't seen in there.
I came in a minute late. The ZID, so is there a choice to sell or they're always going to sell if they get this shock? So.
If you're a day trader, you know that you're going to have to sell early on, so you care about the liquidity.
Oh, you always sell early on?
Yes. So if I'm with a probability gamma, I'm a day trader. I know that I'm a day trader. I want to buy stocks in the morning, but I know that I'm going to have to sell it at night.
Have to sell, independent of the cost. Okay.
Independent of anything. Yeah, exactly. Independent on the cost. But when you're forming your demand on how much stocks you buy, you take that into account.
Can I also ask relating to GID?
Sure.
Yeah, thank you. Hi. I guess in principle, I kind of can imagine that if the funding liquidity increases, so there are more day traders, maybe this cost can increase or decrease. Are you going to consider about any of this correlation between funding and market liquidity? No,
that's a great question. We're not, and you're going to see why. We're going to have to solve this linear pricing. That's going to break linear pricing and make this intractable. But you're going to see it exactly where it shows up. Yeah.
Okay.
We don't have any correlation. That's a good point. And so, again, on modeling the broker, that's going to be important. Yes. Sorry.
Oh, yes, just to jump in on the questions because good to see you. Fine, thank you. So I'm just wondering, from this technological construction, we're kind of separating the roles of allocation from information. There's not the feedback effect of cost of capital going through the stock price.
Yes, that's very important. So that's another thing that would break linearity, and you would see. So the standard idea is managers make decisions based on prices. Prices convey that information that affects what managers do, and that's so basically in the standard discussion. Let me just mention it here now. one of the standard discussion is you learn from prices to make your investment. This is forecasting investment informativeness, and that's why it's important. Here we're going the other way. Price informativeness affects investment, but not the other way. That's why we're making this breakage. A complicated model, we have the nonlinearity. Hey, Venki.
Hey, sorry, go ahead. Leon, go ahead, and then I'll jump in.
Sorry. You okay. Hi,
Guillermo,
hey, how are you?
Yeah.
So I have a question. So here the first one kind of on the shares more like an asset in place. The second one, the consumer part is the new investment.
Yeah.
So the treated asset is asset in place, and the consumer, the new investment will not be part of the payoff to the treated asset. And also, there's a segmentation going on here, right? The consumers, the new investment R and RI, so they are endogenous. But the traders, they treat a different thing, which is the bond. So the RF will be kind of the traders care about, and the consumers care about this R and the fund. So that the new investment, the R and the RA, that's more like somehow the risk-free asset in a sense, I think. But the traders cannot access those things, right? They can only access the consumer, can only access the bonds and the asset in place. So,
So
I mean, the terminology here is you label them as the existing asset, this kind of thing. I think it's probably a more kind of standardized terminology is asset in place, and the foreign bonds are the kind of investment vehicles for the traders. And the new investments are the kind of related to consumers and the mutual fund. It's number two. The number one and number three, those are about the traders. Number two, the consumers and the firm. Yeah. So that is also, I mean, that is also segmentation here. Segmentation in the market. Yes. Yeah.
No, that's very important.
Just want to clarify that part.
Yeah, thank you very much, Ian. That's a great clarification, because effectively the whole surplus of the firm, the part that goes to the assets in place, as you call them, go to traders. All the surplus go to traders. The investment surplus end up going to consumers, because the mutual fund has all bargaining power with the firms and give all that to consumers. So effectively that end up in the hands of consumers. And that's how you split surplus. And there is this perfect segmentation on the split of the surplus. You're exactly right. Thank you for the clarification, Ian. That's important. Thank you.
Thank you. Sorry.
No, it's okay. I'll wait for the Q&A, Guillermo. Go ahead. It's not a huge point, so I'll come back later.
Okay, cool. Thank you guys for all these clarifications. These are all very important. So let me tell you a little bit more about this ZI and ZD. So ZI is the fundamental productivity, has three components. One is publicly observable, that big Z, and this is like an aggregate shock. All the TFP shocks, the business cycles, going to show up from here, but this is publicly observable. There is a learnable component. This is something that investors or traders can learn if they pay some cost, which is this cost that depends on the fraction of investors who learn about that. And that follows a normal distribution with these parameters. And then there is a non-learnable component. So this is even with perfect information, there's going to be mistakes on allocations in this economy, because there is part that is pure noise. And that part follows an AR1 process, but that's not really important. The liquidity component also has these two components. One is a learnable component, so you can learn about the properties of the liquidity, and a non-learnable component. Okay, and these sigma theta, sigma epsilon are the variances on that. And again, traders can learn information about the fundamental and the liquidity properties of the stocks, paying a cost that depends on how many other I'm going to tell you more about that cost when I go to the quantitative part. Okay. Now, so this is just the timing to summarize a little bit what's going on here. So at the beginning of the period, the aggregate state, remember, the aggregate state is the productivity and the fraction or the liquidity role of the stocks, the fraction of people who rely on stocks to obtain liquidity. So that's the aggregate component, and that's what we refer to business cycle, and this is what we refer to liquidity cycle. And the learnable components are realized. Then the day and night traders choose information acquisition and their stock demand. As Ben was saying, day traders know that they're going to be day traders and need to face that cost of liquidity. Households then invest in the mutual fund, and the mutual fund allocates capital observing the prices that happen in the stock markets. Everything else is realized later, and all components become public. Then the day trader sells stocks. You can think, I'm not modeling it here explicitly, but we're working on that. I can tell you more if you want later. Sell a stock to a broker. That broker is going to charge a discount ZID. The day traders consume and die. Production occurs. Funds pay the mutual fund pays the households. And then night traders and the broker sell all the stocks to newborn traders and then consume and die. So that's the timing. And the definition, oops, I erased one slide here, which was the definition. Okay, sorry about that. So the definition is the standard definition, but we're going to focus on linear pricing rational expectations, equilibrium, with an emphasis on the linear pricing. The definition is later. Sorry about that. So let me tell you about the traders' problems. So there are two problems here because of the segmentation that Lian mentioned. One is the traders' problems and the stock market clearing. The other is the real economy problems and the capital clearing, okay? So in the traders' problem is quite standard. So they have to decide how much to demand from stocks, okay? And this is, for instance, the demand of stock, given that they CARA, this should be familiar. This is the demand of stocks by the night traders who are informed. What is given is the expectation of their payoffs, the fundamental plus the price, minus the cost of investment. The alternative is a foreign bond, divided by the variance of their payoff. But notice that this is conditional on learning the learnable components. The difference between the informed and the uninformed is that the uninformed, or the night traders, learn based on the prices, not the learnable components. The difference between the night traders who are here on your left and the day traders who are in your right is that the payoffs of the day traders have this liquidity cost, ZID, okay? But the informed are based on the information, the uninformed are based on prices. So those are the demands, and given those demands, basically you're gonna have the market clearing for stocks, a fraction gamma of them gonna be day traders, that's the demand of the informed and the uninformed, the rest are night traders, the demand of the informed and the uninformed has to be equal to the total stock of capital. And so that's one decision that they have. And the other is information acquisition. Information acquisition is going to be also quite standard. Let me just tell you what this is. It's basically the cost of information given by that expression that depends on the fraction of informed has to be equal to the benefits of information. And the benefit of information is pretty much given by the reduction of the variance that you get from learning the learnable component versus learning from prices, okay? That's where information acquisition is going to be determined by night traders and by day traders. Okay, so on the real side, you have the standard representative consumer who maximizes intertemporally the size investment, and then the mutual funds who is going to allocate capital according to what I said, basically equalizing the marginal revenue with the marginal cost. The marginal cost is R. The marginal revenue is going to be given by the expectation given prices. That's what I was highlighting early on in the initial slides. So it's going to show up here. And then the expectations of the informativeness of price is going to end up affecting how the mutual fund allocates the capital among the firms. And then markets clear. All right. Now, definition of equilibrium is the standard one, linear rational expectation equilibrium. I want to emphasize the linear rational expectations because we want to focus on prices that are linear. Linear on what? On the learnable components of the liquidity properties and the fundamentals of the stock. I'm going to tell you more about that, but we're going to focus on that particular equilibrium. And all the objects in the equilibrium is going to be function of the aggregate state. And again, there are two pieces of the aggregate state here. The changes in Z are the TFP shocks, the business cycle problem. And the changes in gamma are changes in the liquidity role of stock markets that you can think come from a background problem in banking problems, in the financial sector. Any problem that in the production of credit gonna feed back into stocks through a more important role for liquidity, for liquidity. Okay.
Yes. I have a kind of conceptual question here. So you mentioned this gamma can be thought of as a banking problem. Also, that a discount that the private value NZ, N or ZD, some Z, that's a private value to the liquidity traders. So that's also comes from broker discount. How do you think conceptually these two things? They both of them seem to be something related to crisis or to banking problem.
No, this is a question that that Gigi and Ben were kind of also referring. So, and that's what I was saying. So, what we're working right now is on trying to endogenize that ZID. We have to be careful on what, because you can think of banking problems affecting the role of stock prices, which is what we're focusing on, but also on the expectation of how good on basically this part or the ZID effectively, right? Because that's going to make liquidity more costly, things like that. So we're not doing that because that's going to screw up the way to construct a measurable indicator. So what we're working on right now is to endogenize that in a way that enters into payoffs in the way that we have it here linearly. But so far, that's what we have. So I just want to be clear. You're exactly correct. And there may be feedbacks from there, but we don't have that now, okay? Everything enters through gamma, through the importance of stocks for liquidity. That's it, okay?
Could I ask a clarifying question? So
thanks for the clarification. Yeah, sure.
Capital Z is an aggregate shock. Gamma is firm specific, or that's aggregate?
No, that's aggregate too. Remember, gamma is the fraction of traders who rely on stocks to obtain cash. That's
and then
regardless.
ZID is idiosyncratic though?
Exactly. So when you decide to buy a stocks from Apple or from Nike, you're saying, okay, I know that I'm going to need to sell it earlier. How easy is to sell Apple? How easy is to sell Nike? And that's a ZID of each one of those. So that's how you think.
The share of traders who need to sell early, that's moving like the same for all the firms, but the discount they're going to have to incur when they sell early, that's different across all the firms.
Exactly. Okay. That's the thing. So that's the thing. So the importance that you assign to that, or the fraction of people who assign importance to that discount is the one that changes in the economy. Okay. And that affects their demand, of course, once they care about that. All right.
Hi, okay. Feel free. Can I ask? Yeah. Sorry. Feel free to postpone until the Q&A if it's general. But given we've seen the environment, is there something in the environment that points to these being banking stocks as opposed to any kind of other financial intermediary like balance and stuff?
No. So this is the interpretation, but the way I want to think about it is any shock in the economy that makes Asians to rely more on stocks to obtain cash when they need them. So for me, the natural alternative is banks. Whenever you need cash, you have a health problem, you go to a bank and obtain a loan. Now imagine that the bank doesn't give you loans. Now you're going to have to resort more on stocks. That's the type of thing. But any other shock in the economy that generates that could make it.
Perfect. Thanks.
Okay. Thank you. That's a good question.
A clarification question. Hi.
Hey.
Hi. So in the model, so when there's the banking crisis, then everybody sell the shares at a discount. Who benefit from that? Are these people the brokers? They just get the profit?
So right now here is a loss, but again on the broker, I ended up. I mean, this is all a good signal that we really need to get that broker modeled, because right now is loss. It's like, okay, it's a loss from trying to sell earlier, and that's get lost in the economy. The way we're trying to model it, let me postpone the broker to the Q&A because we already been working on that and we have some ideas, but let me postpone it a little bit. Yeah, thank you for that clarification, Julian. All right, so let me tell you a little bit about the pricing in equilibrium, okay? Because that's where the price informative measure is going to come. So there's going to be, as I mentioned, we're going to focus on linear pricing. There's going to be a market price for stock I in a linear equilibrium with that particular linear form, okay? With the characteristic that the ratio of the loadings, notice that phi is the loading on the learnable part of the fundamental of the firm, and phi ID is the loading on the liquidity property of the firm. Now, that ratio is going to be given by this expression. And this expression basically tells you that, for instance, the loading on the fundamental of the firm, that's going to end up affecting the price informativeness, going to be lower when there are less night traders trading upon that, when they're less informed, when the night traders are less informed about the fundamentals of the firm, or when the day payoff is less volatile condition on the learnable part than the night payoff, which is that part. Okay. Now that's just mentioning this ratio. I'm just focusing on because that's going to be important on our definition of price informativeness. So how we want to define price informativeness for, as I was saying, reallocation purposes, different than the price informativeness for forecasting. The way we want to do it is define it in this way. That's going to be our measure of price informativeness. Is in the numerator, you have the unconditional variance minus the variance conditional on observing the price. And then we're going to divide it by the unconditional variance divided the variance conditional on the learnable part. Notice that this object lives between 0 and 1. This object, price informativeness, is going to be 0 when basically you don't learn anything from prices. So this variance is the same as the unconditional one. But imagine that you learn everything from prices, the same as you learn from learning, from the learnable component, then this is going to be equal to 1. So this indicator tells you that if this is 1, you learn from prices as the same as if you were perfectly informed. This being 0 means that you don't learn anything from prices, okay? So that has a nice interpretation. And now, imagine for a second, and we're gonna exploit that in the empirical part, that all the parameters of the firms are the same. What I mean by the parameters, I'm not talking about the realizations, I'm talking about the fundamentals. So the size are the same, the means of the learnable components are the same, and the variances, all where they obtain their individual productivities and liquidity properties come from the same distributions, okay? Imagine that all the firms get the realizations from the same distributions. Then the price informativeness, the fraction of people informed, the loadings on each price, and the price informativeness for each firm is gonna be the same. So if all firms get their realizations from the same distributions and they have the same size, their price informativeness is going to be identical. And it's going to be given by this expression. Okay? Now, this expression tells you what? For instance, when the loading on the day component in the liquidity properties is higher than the loading on the fundamental components, the price informativeness is going to be lower because there is more information related to the liquidity than information related to the fundamentals. And then you have the variances of the learnable component entering here. So for instance, just to give you an extreme, imagine that the variance of the learnable component of the fundamental is 0. So basically you know the learnable component without acquiring information, then there is nothing else extra that you can learn from prices, okay? So that's why they enter here. But again, and I want to highlight it again, this measure of price informativeness, notice that it reveals what you can learn at the moment, your theta I ends. That's what matters. Because that's what matters for reallocation. It's not that it can be, the prices can be very bad at forecasting the future earnings. For instance, if there is a lot of noise in the economy, or the noisy part of the ZIN is very high, but it may be very good at telling you what is the current information so you can make your allocation choices, okay? I just wanted to highlight that again. Okay, so that's a module, basically, how we can take our hands on price informativeness. Now, what we're gonna do is try to structurally estimate that object. So how we gonna do it? We're gonna go to 21 countries, 18 years on average per country, and notice that from the indicator that I just showed you, to compute price informativeness, I just need four numbers, right? I need the loadings on the learnable components on the day, the liquidity properties and the fundamentals of the economy, and the variances of those components. Now, for the loadings, what we're gonna do is to estimate a price regression, a linear price regression like that. So the question is to estimate this and that, okay? Those two. And we can do that outside of the full RBC model because, and this was, I think, who was asking me this? Asset prices, I think Michael. Michael, you were asking me about that. Asset prices are independent of investment choices here. Otherwise, I cannot estimate this function outside of the full RBC model with heterogeneous firms. So that assumption that there is no feedback effect, then that's what allows me to make these estimations. The second important characteristic is that this is going to be identified from cross-section in each country year. So basically what I'm going to do is to estimate this pricing function in each year in each country using the cross-sectional of firms in that year in that country. Okay?
Sorry,
so the identification, yes, Ben.
No, you finish your sentence and then I'll bother.
The identification is going to come not from following one firm over time, but from comparing firms over in a particular period. Yeah, Ben.
I was just going to ask, before you jump into all the quantitative stuff, I mean, I guess you have a pretty simple expression for price informativeness. Could you just give us like a little bit of basic comparative statics on like, in particular, how the gamma affects in equilibrium, the price informativeness?
How the gamma affects the price informativeness.
Right, that's going to be a key parameter that you play around with, right?
No, and I'm going to show you. So the answer, let me just go here because that's important. Here, remember, price informativeness, one important component is this ratio of loadings, right? PD over Pn, right? That's going to be very critical. Now, that's basically the inverse of what I was showing you here.
Yeah.
Right? So imagine that gamma is very high. The loading on the fundamentals is going to be very small, and price informativeness is going to be very small.
So gamma high is a banking crisis or something like that?
Gamma high is a lot of people care about the liquidity properties of the stock. They need to sell the stocks.
I see. So when we care about liquidity properties, then the price is not very informative because we're trading for non-fundamental reasons, something like that.
So let me do it intuitively. When a lot of people care about the liquidity properties of the stock, they're going to trade aggressively against those characteristics. The price is going to convey a lot of information about those characteristics and going to be less informative about the fundamentals of the firm.
Yeah, exactly.
Exactly.
Can I have one quick follow-up question on that, Guillermo? So what is what happens? Is gamma like a shock? Is a gamma a perfectly foreseen deterministic process? What is gamma?
Think on gamma as a TFP shock. Here I'm talking it as a liquidity shock. So again, gamma is an aggregate state in which a lot of agents, a lot of traders care about selling their stock.
But is it IID or something? Or
gonna follow a Markov process that then we're gonna have to.
So then that second term, the variance of ZIN plus PIN prime depends on gamma, no or no?
Yeah, we're gonna have to do something on that.
So that comparative static is I see. Okay, so the comparative static is not just about the first term, right? It comes in through that too. Got it. Okay.
So what I tell Ben is all with a grain of salt, a big one, because these are all endogenous objects. So you have to be careful, and we're gonna discipline this quantitatively, but I cannot give you just a closed form solution because all these things are. Sorry.
Yeah, sorry. I'm also interested in how this gamma and the properties of the ZIN affect the price level. If you think about this, gamma is a liquidity thing, the systematic shock. It will affect the systematic component of beta alpha spread. So the price level PI, so that is sort of related to the beta alpha spread. So the ZIN is more like a future, the next period discount, the next period beta alpha spread, how the future this beta alpha spread affect the current level. That's an idiosyncratic firm specific. So this gamma will affect all the level of all firms, price level of all firms. This is ZIN, the volatility will affect the price level of each firm specifically. So I try to think about this gamma as some systematic component of beta alpha spread. This volatility of ZIN as a kind of a ZID.
ZID. Yeah, no. Yeah. This is the same thing that we were talking, Lian. Yeah, obviously you would like to. I think they're connected. Gamma and ZID in an endogenous model, but you see that then you cannot solve it like this. Let's talk more about that. I agree with that. I mean, this is a big caveat, the one that you're highlighting there. Okay, but just to be clear, gamma here affects the demand for all stocks, given the liquidity properties. I mean, the demand for stocks for liquidity property reasons. And then each stock varies on that, and then they care about those properties. That's the main thing.
So two
Michael.
thoughts. One is that one thing you emphasize in the motivation for the paper is there's a difference between price informativeness about fundamentals and price informativeness about trading and order flow. It might be useful to show the PI for ZID as well, not just for ZIN.
Oh, that could be interesting. Yes. Yes, I don't know how. Yeah, we could compute it. It's going to be very related to this one. The question is, and that can be interesting for other. Here, this particular one is interesting because it maps into allocation of investment across firms. The other may be interesting if you're thinking more of a broker problem or things like more from a financial perspective. That's a good point. Yes, we haven't done it though, but it's easy to do. Okay. So let me just tell you again. So we're going to estimate this object again with the caveat, and you already mentioned that. So, and Ben, again, so this depends on phi N and phi D. These are loadings that are highly endogenous, and these are variances from signals. So these are the purely exogenous, but also affect the phi D, phi N. So these are endogenous objects effectively. But so the loadings, we're gonna just estimate it, and we're gonna get the cross section. Now, the standard models of price informativeness, they put on the right-hand side the realizations of the let's say the fees that the liquidity brokers charge you or the earnings of the firms. We cannot do that because that would bias the results. So what we need is effectively measures of these learnable components. So for the learnable components of the fundamentals, what we're going to do is to use analyst forecast for 6 months ahead, coming from IBS. All right. So basically, this is what the traders can learn is what the forecasters are telling them in terms of what's going to be the fundamentals of the firms. Now, in terms of what is going to be the learnable component of the liquidity properties, and this is where the endogenizing the broker enters. The way we're trying to think about it is that the broker is going to charge you for taking the risk to holding a very volatile stock, for instance. And now we're going to capture it by the volatility of the price in the previous 6 months. So again, the way we're thinking about that is when you're a trader, you're thinking, okay, what is my signal of the volatility of this particular stock? The higher is that volatility, the higher is going to be the discount that they're going to charge me. But that's going to be my signal of the discount that they're going to charge me. So that's how we're thinking it in that particular way. Okay, so those are going to be the two signals that you're going to put into the regressions, and then you're going to estimate the phi Ds and phi N. And then the variances, you're going to just take it from the time series of those two series. Okay. Once you do that, you plug it into the expression. And this is, for instance, for the US. That's what it tells you for the US. Remember, this is living between 0 and 1. 1 is very informative. Prices are very informative. When this is lower, it's less informative. There are 3 periods that price informativeness suffer a lot. One is the COVID crisis. The other is the Great Recession. And the other is this period, late 80s, that corresponds to the kind of relatively longer period of the savings and loan crisis. So at least anecdotally, it seems to be related to some financial disruption as well, particularly when they suffer a lot. Now, the good thing about this, I'm going to show you some regressions because we have this for many countries, and we can make regressions with liquidity cycles and business cycles. But the good thing of having it in this in this particular way is that we measuring the structure is that you can decompose what is behind these drops in price informativeness. Is it that the learnable components became less informative? Maybe information becomes worse, or maybe traders are trading more intensively against one particular component. Sorry, Snehal, you have a question?
Hey, yeah, Guillermo, thanks.
Hi, how are you? Nice to see you.
Good, nice to see you. Your measure of like liquidity information is this volatility, but like, is there some way of breaking that volatility into, because the volatility in returns can be driven both by like noise, like liquidity, or by information, right? And so I wonder if there's some way of decomposing it into like a systematic or idiosyncratic piece, and because this seems very suggestive of like you're just picking up a lot of aggregate volatility in these shocks, right? Like 2000, right before 2009, right after COVID.
what you're saying is right, but just let me separate something. The measure that I have here for making this analysis is at the firm level. So this is the volatility at the firm level. This is the price informativeness in this US stock market in that particular year, okay? And the identification of that comes from all the firms, okay? So the stock market in the US during the year of the COVID was particularly not informative about the fundamentals of the firms.
So, but then maybe it'll be useful to separate aggregate and like firm specific volatility, right? Like there's a factor structure to volatility. And so I wonder if the two are kind of getting confounded in some sense.
Well, the good thing about the cross section, let me just say this, and then I'm gonna just we can talk more about that. Is that if you think that the whole world becomes more volatile in these periods, in this particular type of regression, since they're cross section, that would be picked up by the phi zero. Okay, so this is not picking up the fundamental volatility in the market. Now, just to conclude what I was saying, so just to say again what I was saying.
Can I ask one follow-up question about this picture?
Sure. Go.
So this is identified off the cross-section, and the basic regression is price on analyst forecast of future earnings. So we're learning here is that in these periods where price informativeness falls a lot, like the price doesn't really reflect the forecast very well. Is that?
Yes, and that can be because the forecasts are not very good, or it can be because there is no enough loading into that component. And the question is, which one is it? Thanks to this structural estimation, we can do that because we can plot all the different components. Here they are. They don't tell you much, but thanks to Lian, thanks Lian, by the way, I can personally thank you here. He gave us this idea. So effectively, you can see that our measure can be written in this monotonic transformation such that you decompose whether it comes from changes in the price loadings or changes in the variances or the quality of information. So here, what you see is the solid line is the price informativeness. The dotted one, sorry, I'm just trying to get back the course here. This one is the variances, and these ones are the loadings. So as you can see, a lot of the variation comes from changes in the loadings, the importance of pricing into a given component, not the variances or the quality of information, except maybe a little bit during COVID. Now, if you want to think, okay, which loading become more important, you can also decompose these two price loadings. And you can see that here is a little more difficult to see perhaps, but for instance, for the crisis, basically a lot of information, sorry, here. For the crisis, basically what happens is that there was a lot of trading against the liquidity properties, what we call the liquidity properties of the stock. And during the COVID, there was much less trading against the fundamental property of the firms as well. So the loadings seems to be important here, not so much the quality of information during those particular periods. And this is something that we didn't expect really to, at least to get when we start working on that. So let me just advance because I just have 5 more minutes. Oh, by the way, we have this for many countries. We run a regression if you're wondering how price informativeness changed more systematically. And you can see that they're positively correlated with growth. So economies that grow more stocks tend to be more informative. When the firms have a higher earnings, the stocks tend to be more informative, but also when the banking system do better, the stocks tend to be more informative. Okay, so these are different regressions, or more systematically, that price informativeness seems to be correlated with business cycles and with banking or the financial, some measures in the financial sector. Okay. You may also wonder whether this is at least related to the dispersion of investment. Remember, the idea here is that more information, there's going to be more dispersion of investment because you're going to reallocate better. And here, in fact, you can see that dispersion of investment is positively correlated with this measure of price informativeness. Again, we can do these regressions because we have this measure for many different countries and many different years. Okay, so at least this is like systematically evidence that is correlated to something, this particular measure. All right, so I have 5 minutes, so let me just rush here and telling you a little bit what we're doing. So what we're gonna do is to calibrate this for the US, calibrate the price informativeness on the series of the US that I show you, and then trying to make counterfactuals to see how much banking problems measured with these changes in gamma affect outcomes, and do some counterfactuals. What would have happened if you don't have banking problems, okay? So in order to assess this, to discipline this quantitatively, we have to get some quantitative idea of different things, right? So in particular, how big are these changes in gamma? That for us is like just a parameter. How big or how we can discipline that in the data to make them quantitatively plausible. What is the Markovian process? Some of you were asking about that, how it looks like, how the gamma and the C's are changing over time, and what are the costs of information acquisition, okay? Now, you need to quantify that or calibrate all that simultaneously. Here, I will not bother you much with these regressions. I'm gonna just say a couple of things, and then I just want to go straight to the counterfactuals. So from this loading that I show you, you can just, if you give me the fraction of informed people and these variances, in particular what Benki was asking about the future prices, I can give you the gamma. So we're gonna use a BER process to estimate the process of prices. And we're gonna have to make some assumptions about the information costs of information as a function of the fraction of informed people. And this is a functional form that we're gonna use, and we're gonna calibrate the parameters of these functional forms. Now, if you give me the cost functions, for instance, I can give you the gammas. But then that has to be consistent with the whole pricing function. And for that, it has to be consistent with the Markov process. So the way we're gonna do it is to discretize all the years in the US into 4 states: 2 productivity shocks, high and low, and 2 gamma shocks, high and low. And this is what the calibration basically tell us. So these are the C shocks, these are the low productivity shocks, and in each and these are the high productivity shocks. And then you can have low liquidity shock or high liquidity shock in each one. Okay, this is 38% of the people rely on stocks for liquidity purposes, or 80% of the people rely on stocks for liquidity purposes. And the C, basically the calibration assigns the years to each one of the states. So this would be, if you want a normal state or a good state, high productivity, low liquidity needs. This would be a bad state, low productivity, high liquidity needs. But you were asking me, I think Bruno, you were asking me, can I do the exercise only with banking shocks? That would be going to, let's say, from this state to that state, when you don't have a TFP shock, but you have a liquidity shock. So we could do that type of analysis. So we calibrate the model. I will not bother you with that. I'm gonna just show you the counterfactuals, and in 2 minutes, I'm gonna tell you 2 results. One is comparing recessions with and without a banking crisis, okay? So that's what we're doing in this figure. So the dashed line, these dash points, are recessions without a banking crisis, right? So it's a negative shock in productivity, no change in gamma. This is on impact, only one period, a shock in productivity, only one period, then you go back to normality, no change in gamma. What happens in that situation? Well, there is some extra information acquisition about the fundamentals, and a lot of information acquisition about the liquidity properties. Overall, there is more information acquisition in the economy, in recessions without banking crisis, and more price informativeness. And this is the drop in output that you would have in that situation, up to that point. Okay, now compare that with a situation in which you have the same reduction in productivity, but now a big increase in gamma. Okay, is a recession with a banking crisis. Now, what you're gonna have is some more information about the liquidity properties, but much more information acquisition about the fundamentals, because now prices convey less information about the fundamentals. Even though there is so much information acquisition in those particular periods, price informativeness dropped. Why is that? Because even though people acquiring a lot of information, there is less trading based on that information, and there is more aggressive trading based on the liquidity shock, such that output goes down a lot because of this misallocation. Okay, it doubles according to this calibration, at least, compared to a recession without a banking crisis. Now, here you can see we can run the regressions both with GDP growth and liquidity measures, and you can see that this is consistent. Let me just take the fourth column. You can see that if GDP goes down, price informativeness go up a little bit, is negative relation, but not that much. Focus on the fourth column. But if the liquidity measure, for instance, by not performing loans go up, price informativeness really suffer in those periods. The final thing that I'm going to say is that we also make counterfactuals with what would have happened. This is the benchmark in which you go to a recession with a banking crisis. What would have happened if you don't allow for endogenous information acquisition? The drop in output would be much larger. If you make information about fundamentals easier, the output drop would be lower. If you make information about liquidity properties of the market or the firms in the market, let's say information about the brokers, easier, you would have a worse recession. Okay, so let me just conclude because I'm out of time. Basically, we build a model of asset trading with endogenous noise because you have these two traders trading for different reasons. We integrated into an RBC setting, simultaneously capturing information acquisition and misallocation of resources. We structurally estimate the stock price informativeness and show that it declines during recessions with distress in financial sectors in particular. And then the calibration to the US shows that not all recessions are equal. Recessions without banking financial distress make prices more informativeness, improve allocations, and buffer output losses. Recessions with financial crisis make prices less informativeness, weaken allocations, and magnify output losses. So let me stop here, and thank you very much for all the comments. They were great.
Great, thanks a lot, Guillermo. Pretty much on time, even though you got a lot of questions. That's excellent. So we have 15 minutes of Q&A. So the panelists can just go ahead and ask more questions, and also the regular attendees can use the Q&A function and then, or the chat, and we can also answer these questions. So yeah, just whoever has a question, you and Jan, please go ahead.
Hi, Guillermo. It's a great paper. I really like the story. So one question about the estimation of the loading on the liquidity shock is you use the volatility of the stock market as the proxy for the ZID, I think. So combined with the assumption that you assume that the traders have a constant risk aversion, are you concerned that you're attributing some of the changing risk aversion to the informativeness about the liquidity shock of the stock price? Because when you observe that the price decrease with the liquidity shock, it might be that people are becoming more risk averse. So I think it's a story. I'll stop to your model, but how I would like to hear your comment on that.
So let me understand. So you're saying maybe in certain periods traders become more risk averse?
Yes.
But this is related to it could be there are years in which they're more risk averse, in the same way that there can be periods in which the market is more volatile. But that's, as I was saying, if you run these regressions, since the identification comes from the cross-section, that would be pinned down in the level. That would be common for all firms. So that would be pinned down by the intercept. So all those systematic changes in a country that is common to all firms, that will not enter into these loadings that are coming from the identification comes from the idiosyncratic components. Yeah. Unless you have different risk aversion for different firms or some things like that, then that would be a problem for this specification. Thank you, Junya.
But even that wouldn't be in a sense, wouldn't be a problem, right? Because you could imagine, so suppose you thought that people invested, had curvature, and traders had curvature in their utility with respect to individual stocks.
That's what I'm saying.
No, but but I'm saying one interpretation of what financial crises do is that, no? Like, at this point, it's a little bit reduced form what this gamma is. And if all you're saying is, yeah, I care less about the fundamental value. I trade less aggressively on that. So we went back to the Grossman-Stiglitz formulation, right? So you would have a model, a thing where there would be like, a risk aversion times the uncertainty would dampen your incentives to trade. And if that's how the financial crisis acts, then that's fine for your story, I think, no? Yeah.
Yeah, I agree with that. So whatever is the reason that creates that, and it can be, let's say, some heterogeneous way in which risk aversion enters, that's perfectly fine, and that's a matter of interpretation. The reason we were going towards the banking thing is that on doing all these regressions, this seems to be in general correlated with those particular epics.
No, but that's what I'm saying. It could be that banking or financial crisis makes agents act in a more risk-averse way, and that's a perfectly fine.
Definitely. But that should be, that comes with some distress on the financial. So the way I'm interpreting it is maybe there is a curtail of credit. I'm just trying to reinterpret what you guys are saying. It can be also that there's stop functioning. Let's say that derivative markets function less, so you need to, you're more risk averse on trading stocks in a particular way as well. So any type of problems in the financial sector could make it. That's a good point. Thanks. Lian, you're muted, Lian.
Okay, sorry, it's a great paper, so I like it a lot. I think so. Have you tried to make a connection to the finance literature on price informativeness? I think you must know the paper by Penn and Thomas Philippon and Alex. So in 2006 they showed the U.S. market the price informativeness increased over time. And Laura Veldkamp and kind of co-author Babudi, and they showed kind of this component effect, composition effect. And then also kind of literature in China, the Carpenter showed this thing also holds in China, in Chinese market. And recently, Wei and Zhiguo, they argue this might be related to kind of earnings manipulation, and this in China, the Chinese price informativeness. So I think this is kind of active literature in finance. Here, you have a very novel perspective, kind of interaction between kind of price informativeness and this banking liquidity. So that might be able to contribute to this debate from this angle. But this also makes me to think, so probably it's also very kind of important to think about this gamma, how to exactly interpret this gamma. And also about, if here is about the price informativeness and GDP growth rate, if we think about the welfare, everything, so this gamma sort of is exogenous. It might need to think about how to think about the welfare. This gamma related to welfare. And finally, kind of a naive question, when you try to estimate the equation, the PAI equal to this theta D is theta IN. So here, have you done anything about the normalization? You normalize the price by dividend or by something, or think about the return? If not, I'm just concerned with some co-integration issue. So it is to have on different levels. One is the price increasing, the other one is earnings. I'm not sure how to think about the levels on the left-hand side and on the right-hand side. So this is kind of overall question about the price informativeness.
So okay, so you raised 3 points, Lian. Let me go one by one. So the first one is about the relation with the literature, and that's why I was trying. That's a very interesting point. And that's why I was emphasizing that all that literature effectively cares about a different concept of price informativeness than us. That is very important for investors, but not so important for allocation of resources, we think. In the sense that the question is how well the prices predict the earnings in the future, and that's going to lead your investment choices. That's going to be related in some way to allocation of resources, but not in terms of allocating resources today, given what we know. So the way I think about that, and maybe this is going to be crazy, is like the weather channel the weather application in your iPhone. Because one thing is to ask whether the weather application is very good in predicting whether it's going to be raining in 1 week or not. That's an exogenous process, and all that literature that you refer to take the earnings as such exogenous process. A different question is, okay, how good the application is, so I can I can use the best that is known today to decide whether to use an umbrella or not. And then the question is how well the weather application is today to predict whether I'm going to be wet in 1 week or not. Because then I have to filter the endogenous choice that I made based on the price today. So there is some discussion there that I think is important. One of the leaders on that discussion, I think, was Itai has this survey making this, and you've been working a lot on that, on revelatory versus forecasting price informativeness. Most of the empirical literature is about the forecasting one. We haven't seen.
One follow-up question on this is you don't really have even a concept of forecasting price efficiency here. The market is learning nothing from the firm. The firm is only learning from the market.
The firm, no, right. No, what I meant is whether the market is learning from prices. That's what I meant.
No, but I think it's related, Guillermo, in the following sense. So because you could imagine, take the following extreme view, right?
Yeah.
Imagine that the firm knows everything.
Okay.
There is never any information friction on the firm, but somehow that information never leaks to the market. That's a world in which efficiency and real there's no distortion to investment because everybody who's making the investment knows everything perfectly. It's just the clueless traders who create noise in prices. Now, I'm not arguing for that as this thing, but I'm just saying,
no, that's a way to think about it. That's not the way. So that's perfectly fine, Benki, and I thought a lot about that. But that would be also a war. We have to be careful about some of the assumptions, right? So that would be a war in which the managers who have the perfect information have also the funds to make these investments. Now imagine a war in which the manager have all the information, but investors, let's say banks, investors in the firms, etc., rely on the market to whether invest or not, to give funds or not. Then that would be a war in which the manager can have, so the managers would maybe learn or not from the firms, but whoever provides the funds still learn from what the market has to say. So it depends on what are the frictions. I mean,
I guess some of the identification for this then is coming off of like the model implied pricing equation. But imagine you took a different approach and you figured out like a nice instrument for market information, and then you see whether the firm's investment responds to that instrument.
Right, exactly. So what is the best that we so what we you guys have something like that I think in your papers. The best thing that we did here, since this is a measure at an aggregate level, is this dispersion of investment as a function of the PI, because we have a measure that is based on the cross section, so it's an aggregate per year. So we don't really can do that because it's a price informativeness in total of the market, not the price informativeness of a particular firm. So in the type of forecasting that Liane mentions, like what Filippone is doing or Laura, that you can get price informativeness per firm, you can see how reactive the investment of that particular firm is to that thing. We cannot do that. The best that we can do is to go with the dispersion. But there may be other ways. If you guys have ideas, that would be fantastic.
Can I just sorry, I feel like I'm taking up people who have politely raised their hands and waiting for their chance. So I'll stop and I'll let Michael and Jihye talk, and then I'll come back to this.
Wow, self-restricted and put mute himself. That's good. Thank you. Okay, so Michael, sorry.
Oh yeah, sure. Well, really enjoyed the paper. I'll be a bit nicer than Liane with only 2 thoughts or questions. One is, if you're trying to endogenize the brokers, maybe look at Zhang Wang's 1994 JPE paper, and then it would be like a bet with your broker, that if the broker's bet pays out, you get additional boom, but if it goes down, then you get it out of your stock return. So that's like one way that people have done to endogenize this.
Michael, can you put in the chat the reference? That would be very useful.
Sure. And then the other thing is, I really like the quantitative nature of the paper, but it's also useful to highlight the novelty of the mechanism. Like if you look at other papers where you have uncertainty traps, like Benabi, Blue Wang, Dow, Goldstein, Gumbel, it's about the incentives to acquire information about the firm that just flatten. Here, it's actually the incentives to acquire information about the other side, the liquidity that's causing the flattening. And that's really a really interesting novel interaction.
Thank you. That's great. Thanks for pointing that out, Michael. Thanks a lot. Jihi.
Yeah,
sorry, I'm sure that I mispronounced it. Sorry.
No. You are perfect. Yeah, I will be kicked so that we can go back to the intense discussion again. Thank you so much for a great talk. I'm just curious about the when it comes to the empirical kind of counterfactuals, like I wonder how to take these numbers, given that in your model, traders are short-lived, but I guess in the actual market, there might be traders who actually trade multiple rounds. Like the kind of situation that I have in mind is that like a trader who is actually trade for the fundamental reasons, but given that there is some liquidity issue in the market, they may actually split their orders over time, and then if we are kind of ignoring that channel, maybe these players can be maybe like captured as liquidity pursuing rather than the fundamental trading in the period that other than when they entered. So like more generally, I think like I'm curious about what would change or whether it would change if we consider the long-lived traders.
Sorry, what you said at the end?
If the traders actually trade more than one round, then would anything change quantitatively or qualitatively?
That's a good question. Yeah, so to be honest, I'm not sure. The big question here is going to be tractability. I mean, I'm sure that there are ways in which you can extend the model there. That sounds like the concerns for liquidities are also quite endogenous, and then the demand for stocks going to depend on intertemporal issues. I'm sure that you could extend it. The question is how tractable that becomes. Because something that I have to be very, very honest and upfront is that we know this from many years of finance literature. It's very easy to lose the tractability of linearity of prices. And once you lose that, or you make it correlated with the whole model, then going empirical really becomes a big issue. In fact, that there is something that I wanted to mention as well to Liang, who were asking about the empirical part. We made a lot, and let me just for the completeness, and if he's around still. So there, all these sample restrictions, timing, all the things that appear here in the slides, and if you can see it, I will not touch on those now unless you want me to. But yeah, here this is all prices per earnings with the three FAMA factors. We're trying to kill any heterogeneity that existed across firms just to believe more on the cross-section identification. So we did a lot of work on that. I don't know if it's perfect, likely not. But yeah, so that the tractability is an issue in that sense.
Okay, thank you. Yeah, very nice. Thank you.
Okay, thanks. So given the time, I think it's a good moment to end the official part. Then Venki can come back after that, but let's end the recording here. Let me just maybe say that the next Search and Matching in Macro Finance SAMF seminar is on the 4th of November. Adrian Daverna will present the deposit business at large versus small banks. So please join us for that in about a month on the 4th of November. And that was it for today for the recording at least. And thanks again to Guillermo for a great paper.
Thanks a lot.
Those who want to stick around, please stick around. We can have some more informal discussions after the recording ends. Thanks, everyone.
Thank you, everybody.